Hello traders, Steve Ganz here, and I want to share two opposing trades with you as we're coming up on Nvidia earnings. So Nvidia reports earnings this Wednesday, that's August 28th after the close. Now, I also had someone request in the comments that they wanted to see the difference between an iron butterfly and an inverse iron butterfly. So I figured this is the perfect opportunity to kind of compare and contrast those two different trades and how they might potentially act around earnings. So this is on Nvidia, and I'm going to the closest expiration after their August 28th earnings. So that's August 30th. That's the closest expiration. Those options are going to have the highest volatility reading in them because they're the ones that are immediately following that earnings report. And of course, what drives volatility up as you go into earnings is that nobody really knows earnings going to be good earnings, bad earnings, and even if they're good or bad, that really in itself doesn't make a difference. It's how the market reacts after those earnings come out. So there's a couple different possibilities here. Many people will look at doing an iron butterfly or an iron condor. So that's essentially selling a put spread and then selling a call spread at or near the money. Now we're currently trading at 127. I just centered this around 130 for the sake of simplicity. And then I've gone, in this case, 20 points either side. So putting on this trade gives me a P&L diagram that looks like this. And if Nvidia ends up somewhere between our break-evens of 117.80 and 142, that's a pretty darn wide range. But if it ends up in that range at expiration, this thing is going to decay quite rapidly, and there will be profitability that will come into this trade. The other thing that's going to happen is right after that earnings announcement, many times, not every time, and Brett is going to, in his blog, address this issue as well. So take a look at his blog post and see his thoughts on Nvidia and how it might actually expand in volatility if the earnings aren't so good. And if that happens, if we get outside of the tent and volatility expands, we can see that's not going to be so good for this specific iron butterfly trade. However, an opposing view on this trade here is an inverse iron butterfly. So in this particular case, if the volatility were to happen to go up, that's going to bring a lot of profitability into this trade. And of course, as time passes, that's going to help as well, so long as we're outside the tent. Again, over here, we want to be inside the tent. We want volatility to largely drop out of this trade. If we're doing an inverse iron butterfly, if we get outside of that zone, if we drop outside of the tent, so to speak, or our break-evens, notice our break-evens here are pretty much the same, the 117.63, 142, basically the same over here. So here we want to be outside after earnings, and ideally, volatility might spike up. If volatility doesn't spike up and we're still outside of the tent here, we drop down to the 110 range or so, that's all fine and good too. But again, things can improve in this trade if we get both of those. If we get time passes, we get past the earnings date, and the volatility spikes, in that case, we could even still be inside this tent a little bit and have some profitability. So the goal here is to just kind of show a compare and contrast, if you will, on these two different trades. We can see, in this case, the net credit we're going to take in $1,222. And of course, our idea or our goal is to buy this back for as cheaply as we can if we were to peg these center strikes right here at expiration, which is highly unlikely. If that were to happen, we'd be able to buy this thing back for a few bucks and we'd have about $1,200 in profit. Now here we're paying a debit for this trade, but when it comes time to exit the trade, we would be selling the butterfly and we could potentially have a profit here of about that same amount, $760, somewhere in that general range. Now let's take a look at all of the stats. If you have the paid version of OptionStrat, you're also going to see all of the Greeks here. And you'll see that they're pretty much the inverse of each other. So all of those are great tools in OptionStrat to help you kind of model and decide what type of interest or what type of trade that you might want to consider.